Chapter 16, Financial Risk, Payment Methods, and Trade Finance. Financial issues are often challenging for international transactions because there are so many different things to consider beyond what you'd have to consider for domestic transactions. Case in point, international financial risk is higher because oftentimes there's incomplete data. In the United States, it's so easy to just look at a Dun& and Bradstreet report or get a credit report on a company. Internationally, that oftentimes is a lot more challenging. There's greater opportunity for procedural errors, and as we've seen, as we will see rather, with letters of credit, it's extremely important for documents to be correct. There can be unexpected events. We'll look at that in a minute. And company financials can be more challenging to obtain. There are three main types of financial risk. The first is commercial risk, and that's the possibility that the company might be having, let's say, problems either in terms of insufficient cash flow or just financial difficulties that mean that the buyer won't pay the seller for the goods. They could run into political risk. This could be due to political instability, or it could be, let's say, the government decides that they're going to nationalize. Case in point, in 2012, the Argentinian government nationalized an oil company. Right now, they're looking at renationalizing the railroads. So political risk is a big factor in many parts of the world. And then there's foreign exchange risk. And there are three main types of foreign exchange risk. There's the transaction risk that, let's say that the exchange rate changes and it makes the transaction that you're currently working on less profitable. This could happen if, let's say, between the time that the contract was signed and the money actually changed hands, was exchanged. Let's say the dollar appreciated. Well, that would mean that an American exporter's goods become more expensive. And if that happened at the time of the transaction, it could make the transaction less profitable or unprofitable altogether. Economic risk is that over a period of time, that exporter's status could become unfavorable. You know, then the same example holds. Let's say that the dollar appreciated. This could affect all of an exporter's exports because it makes the American exporter's products more expensive. And as your author points out, this becomes even more severe if one of their competitors at the same time has a currency that depreciates, meaning their exports become more competitive. And last is, of course, translation risk. And this is when financial documents are translated from one currency to another. Assets could increase or decrease in value quite markedly. There are ways to protect yourself in terms of transaction risk. Large companies that have foreign subsidiaries have the option of netting, which is where they're basically engaging in an offsetting transaction at the same time so that it nets out, so that the currency impact nets out. Another option is a forward contract where you're basically locking in a rate in 30, 60, or 90 days. A futures contract is similar to a forward contract in that you're locking in a future rate of exchange. And you know what? You can find the forward rates listed in the Wall Street Journal and online, obviously, to see what the exchange rate would be for a forward contract in 30, 60, 90 days. In any case, a futures contract is a little bit more flexible because it allows you to sell the contract during that 30, 60, 90-day period. And then an options contract is still more flexible because it gives you the option. With a forward or futures, you have to exercise it at the end of the time period. With an option contract, you don't. All right, there are various payment methods that may entail more or less risk for the exporter. Obviously, the one that entails the least amount of risk for the exporter is cash in advance, but it should be equally obvious that that one, however, entails the most risk for the importer, for the buyer. When dealing with new companies, that may make sense, but over time, as some trust is established, usually firms offer better terms. So one option would be documentary collections, in which the documents, the shipping documents, trade documents, are presented to a bank, and then the bank makes payment. Um, a more secure form for both the exporter and the importer is a letter of credit, or LOC, which substitutes the creditworthiness of the bank for the importer. There are two types of letters of credit. There's the sight draft, which is payable upon sight, a presentation of documents, and the time draft that's payable after the stipulated period of time. We're going to look at letters of credit in a little bit more detail. But first, I want to touch on the Export-Import Bank. They have several three very important programs for the exporter to be aware of. One is the Export Credit Insurance Program, which guarantees payment if the buyer doesn't pay. The Export-Import Bank right now is very contentious, and in fact in 2012 it was contentious enough that it was debatable whether it would continue to be funded, whether it would continue to survive. The problem with Ex-Im Bank is it's now criticized as kind of a form of corporate welfare. And in fact, most exporters don't take advantage of the bank, only about 2% do. And those that do tend to be very, very large corporations, like you see Boeing on the right. Boeing's a big beneficiary of Ex-Im Bank. So right now, it's kind of a political football, and it remains to be seen whether Ex-Im Bank will continue to exist. But let's look at letters of credit in a little bit more detail. So on the left side of the screen, you see the exporter or seller. On the right side, you see the importer or buyer. And right here, you see the importer's bank. They are critically important because they are the ones that are issuing the letter of credit at the importer's request. On this side, we see the advising bank. And the advising bank, they're going to receive the letter of credit from the issuing bank. However, this advising bank, if requested, if the exporter is willing to pay a little bit extra, they may also act as the confirming bank. So I said a minute ago that a letter of credit is very appealing because the issuing bank is promising to pay, assuming that the documents are received and in order. If the exporter is not sure about the foreign bank, then they may request their bank act as a confirming bank, which means that in the event that the issuing bank doesn't pay, the confirming bank promises to pay. So let's look at a little bit closer at what a letter of credit would look like. So first, the contract is issued for the goods. Second, the importer or buyer fills out an application with their issuing bank requesting an LOC or letter of credit. At this time, they may also have to put money in the bank, or they may have to use a line of credit as collateral, because obviously the issuing bank wants to make sure that they get their money as well. Next, the letter of credit is sent from the issuing bank to the advising bank. Then it's sent from the advising bank to the exporter.